Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash flowing properties in today's market. Here's your host, Gabe Peterson.
All right. Welcome back to another episode of the Real Estate Investing Club. Again, bringing that Friday energy to you guys. I hope you guys are having an absolutely fantastic day. Still absolutely stunningly beautiful outside here in Seattle. Zero clouds. I'm going to give you guys the weather report every time we get on here because it's going to be sunny for the next couple of months. And us in Seattle, we love it. So I hope you guys are having a good day. It's a good day for another reason because we have Erik Oliver with us on the show today from Cost Seg Authority. He is here to talk about his investments and then also cost segregation, which is a strategy that a lot of people need to implement into their own investments to save on taxes, the thing nobody likes to pay. So Erik, thank you very much for hopping on the show.
Yeah, no, thanks, Gabe. Glad to be here.
Absolutely. I told you before we got on here, we always like to start with stories and hear how people got into the path they're on today. So why don't you take us to the beginning of your story and tell us how'd you get into real estate?
Yeah, that's a great question. So I kind of stumbled in it unintentionally. So I was living in Virginia at the time, was changing jobs, going to move to New York, and had a house in Virginia. And we decided instead of selling it that we were going to rent it. I learned quickly that trying to manage a house in Virginia from New York is not the smartest thing, and learned the hard way that I probably should have hired a management company and probably should have done a better background check on my tenants. And
it's a lesson everybody learns. Don't worry about it.
It was an absolute train wreck, that first rental property. And so anyway, so that was my first experience in real estate, was an absolute train wreck. I ended up moving from New York to Salt Lake, where I was born and raised. When I moved, I sold that house in Virginia. But when I moved, I got into cost segregation. Didn't know what it was at the time. Been doing that for about 7 years, but that's really led me into a lot of other avenues. We presented a lot of real estate events. And so since then, I have invested in, I've got a long-term rental, a short-term rental, and then some micro apartments that were invested in an opportunity zone.
Nice. Yeah, and we will get into that. You and I were talking before the show. Micro apartments is an interesting asset. And then the fact that it's in an opportunity zone, well, we'll talk about it later. But before that, I want to get into cost segregation because it is something, I've done it on properties that I own. I had no idea what it was before before a couple of years ago when I got into commercial in 2019, had no idea what a cost segregation study was. So it is something that most new investors won't know about, but it's a lesson that is definitely useful. So why don't you tell people what is cost segregation? How does it help you?
Sure. So cost segregation really is just accelerated depreciation. So one of the benefits of getting into real estate is the ability to take a depreciation deduction against your income. So basically the IRS says, hey, when you own a property, that property is going to deteriorate over time, and you get to take a write-off because of that deterioration, and that's called depreciation. Now, that depreciation normally is spread out either over 27 and a half years for residential units.
So weird that it's 27 and a half. Do you know why?
I know, right? I have no idea where the half year came from. That's the IRS for you, federal government. So the 27 and a half year for residential units, if you own commercial real estate, it's 39 years. And so a lot of people take what we call straight line depreciation, meaning I'll just use an example to make the math easy. Let's say you buy an office condo, so it's commercial, for $390,000. Essentially, you're going to get a $10,000 write-off every year for the next 39 years. You take your $390,000, divide it by 39 years, and that's a $10,000 write-off every year, which is great. Again, that's why we get into real estate. The problem with that is I don't plan on owning my property for 39 years. I'm probably going to only invest in it, 5 to 7 years or what have you. And so I want as much deduction now that I can get. I don't want to wait and take 1/39th for the next 39 years. So the way we can do that is when I bought that office condo, I didn't just buy the land and the walls. I also bought the parking lot. I bought the appliances in the break room. I bought the cabinets, the countertops, the flooring, the lighting. There's all these different components that I bought for that $390,000. And the IRS, for example, says the parking lot doesn't last 39 years. A parking lot is actually a 15-year asset. The flooring and the carpet in the building is a 5-year asset. Now, that's not actually how long those assets are good for, but those are the categories that they've been classified according to the IRS. So a cost segregation study comes in and takes that $390,000 purchase price. We always have to back out the land value because land is non-depreciable, but whatever's left in my building, I now break that up, or just as the name implies, I segregate that cost into different buckets. And now I have a bucket of 5-year assets, let's call it $80,000, that I get to depreciate over 5 years. I got a bucket of 15-year assets, let's call it another $80,000 that I'm depreciating over 15 years. And then the remainder stays in that long-term category. But by breaking this out into different buckets, it creates a much larger deduction in the early years, which, if you know anything about money, there's time value of money, there's inflation. There's all kinds of reasons why we want our deductions now versus spreading them out evenly over 39 years. So, and then not to complicate things, Gabe, but there's something called bonus depreciation, which puts cost segregation on steroids and allows me to take an even bigger chunk in those first couple years than I normally would have. Instead of splitting my 5-year assets up over 5 years, I may be able to take 60% or 80% or at times even 100% of those deductions all in the first year. So again, really at its core, it's just accelerating the depreciation on your real estate assets.
Yep. And so actually, just out of curiosity, what part of the real estate is classified as a 39-year depreciation table?
Yeah, so it's usually around 70% of a building. That's kind of an industry average. So,
Okay.
And that's things like doors, roof, walls,
structure, the bones.
Steel, the bones, yeah.
Yeah.
That's all your 39-year asset. All your 5-year asset is the internal components that aren't structural. So carpet, countertops, partition, window coverings, all those types of things. And then the other major category is the 15-year land improvements. That's all your exterior curbs, gutters, asphalt, sidewalks, trees, bushes, shrubs, retaining walls, etc. Those are kind of the 3 main categories.
Yep. Yeah. And so, and I'm just saying this because I learned it not recently, so I like to tell people from the perspective of me being a newbie a couple years ago. So a cost segregation study is basically the process of hiring somebody to come out and bucket your property into all these little segments, so you can take that depreciation and apply it to income. And so who benefits from this? What kind of income can you apply this depreciation to?
Yeah, so anybody with a revenue generating property. So anything from heck, we've done basement apartments all the way up to ski resorts can benefit from cost segregation. The thing you want to be familiar with is cost segregation, or real estate typically is considered a passive investment for most of us. So I myself am a W employee here at Cost Seg Authority. I own real estate on the side. When I do cost segregation on that real estate, I can't use it to offset my W-2 income because that's my active income. So for most of us, these deductions are considered passive. Yeah. However, there are some ways around that because if I have high W-2 income, I need deductions. And so one way is to become a real estate professional, which I'm sure they've probably heard on your show about. Requires you to do 750 hours a year of real estate activities. 51% of your working time needs to be in real estate. So a lot of high W-2 earners, let's say I'm a doctor and I make $500,000 a year, maybe my spouse who stays at home manages our rental properties. Now we can do cost seg on those rental properties. Those deductions now become active because my wife is a real estate professional, and I can now use those deductions to offset my high doctor income. That's a case where that's kind of like having the golden ticket, where if your spouse can qualify as a real estate professional, you use those deductions to offset all types of income. But for me, my wife is in the school system. She's not a real estate professional. She's in the school system. I'm a W-2 employee. And so my cost seg deductions can only be used to offset other passive income. So I don't pay any taxes on my real estate income that I make from my properties because I have all these deductions from my cost seg studies. Unfortunately, I still pay taxes on my W-2 income, and my wife still pays taxes on her W-2 income, but there are some ways around that we can talk about.
Nice. Yeah, they are. I mean, they're going to get you somehow. You can't get the
Yeah,
government nothing.
right.
Awesome. So for people who want to get a cost segregation study, I didn't know that you could apply it to single family. So it sounds like anything that you rent out, you can do a cost segregation study on, but it only makes sense if the rental amount, your net income exceeds a certain point. It would make sense to me, because you don't want to do a cost segregation study, have $200,000 that you can apply towards taxes, but only have a revenue of $200 a month or something like that.
Exactly. No, you hit it on the head. So that's about the only time you don't want to do cost seg is when you don't have any income to apply those deductions to. Because just like you said, if I create a $200,000 deduction, but you only have 10,000 of income every year, it's going to take you. You don't ever lose these deductions. You can apply it, and it'll just carry forward. But it's going to take you 20 years to use that, right? So why not just take the standard 27 and a half year and not pay us for a study? So most cost segregation companies out there will always do a free benefit analysis to get an idea of what the expected tax savings could potentially look like, as well as what our fee would be. And then you can share that with your tax preparer, your wealth advisor, whomever, to determine if it makes sense. And we can help walk you through when it makes sense and when it doesn't. But there are definitely times when cost seg doesn't make sense. Some smaller properties, let's say I'm buying a $60,000 home in downtown Detroit, maybe it doesn't make sense because I'm going to get I am going to save some money. I might save $2,000 or $3,000 on my taxes, but you also have to pay, $3,000 for the cost seg study. In that case, it's just a wash and it doesn't make sense. So those are kind of the two times you don't. The other time, like you said, you can't do cost segregation on your primary residence. But other than that, cost segregation is a very valuable tax strategy where even if I'm not in a high income bracket this year and I don't need the deductions this year, I just keep the cost seg in my pocket, and I'm allowed to do cost segregation in a future year on that property and take the deductions in that future year. So you want to use cost segregation to really manage your tax brackets and use it in years where you have high income. And that's one of the few deductions that I know of in real estate. If I go build a pool in the back of one of my rental properties, I have to take those expenses in the year I build the pool. I don't have an option. Even if I don't have high income that year, I've got to take those in that year. Cost segregation, you want to use it in the years you've got high income when you're in the highest tax brackets. And the IRS allows us to kind of pick and choose the years that we utilize those deductions, which is great.
So if I did a cost seg study on, like we did one on a mobile home park we bought recently, can we apply the depreciation to active income that we make in real estate, wholesales, flips, that kind of stuff?
Yes.
Yes.
Yeah.
All right. There you go.
Absolutely.
Easy. I love it. All right, man. Well, hey, I'm going to move us on. Cost segregation is super beneficial, especially if you guys are out there and you're in commercial like me, get one done on your properties. It's going to help a bunch. Erik is from costsegauthority.com. So go there to get us cost seg study done. So Erik, let's talk about your investments. We've already alluded to a couple of them. You mentioned you've invested in efficiency apartments, in opportunity zones, and a short-term rental.
Yeah.
And there was a loophole that you mentioned on that short-term rental. So let's start in the STR and tell us about the short-term rental that you bought. How'd it go? Where'd you find it? And then what was that loophole you mentioned?
Sure. So as we talked about, I am a W-2 employee. My wife is a W-2 employee, and I had a high tax year and I needed deductions in 2022. And so normally I had a long-term rental at the time, but if I were to do cost seg on that long-term rental, I couldn't use those deductions to offset my W-2 income, as I'd mentioned. However, if you have a short-term rental, if the average stay is less than 7 days, which it typically always is, and if you materially participate in the management of that property, which I did on this property, then you're able to classify those deductions as active deductions. So the way the IRS looks at it is I basically am running a hotel business and I manage that hotel business. So short-term rentals get classified as 39-year assets, not 27 and a half. And they get classified, if I meet that criteria, I can classify that deduction as active deductions versus passive. So the story goes at the end of 2022, I was strategic about buying a short-term rental in November. I put $80,000 down on it and did a cost seg study on it. And I was able to get about $60,000 back by doing the cost seg study. So I was going to have to send the IRS $80,000 that following April. Instead, I went and bought a revenue generating property. I managed that property for November and December, just the 2 months. I spent more time at that property than anyone else managing it because I had to set it up. I was there more than the cleaner, more than the maintenance guy. That's one of the criteria that I met. The average stay was less than 7 days. We had a number of renters those first 2 months. The average stay was less than 7 days. Did a cost seg study for tax purposes, created about $160,000 deduction, was able to offset my income and create a huge tax savings. So for me, I could have not bought a property and just sent the IRS a check for $80,000 in April.
That's not fun, though.
That's
Nobody
not
wants to do
fun.
that.
But because I knew about cost segregation and I knew about this short-term rental loophole, they call it a loophole. I hate to use the word loophole because it sounds like we're doing something nefarious, but it's not a loophole. It's just the way that you think hotels are treated differently than rental properties, and so are short-term rentals. They're like a hotel business. And so basically, I tell the IRS that I'm running a hotel business, essentially. It's a little more than that, but that's essentially the idea. And because I'm running it, those deductions are active. And so I was able to offset my W-2 income by $160,000, which created that huge tax savings, which helped cover my down payment. And so again, it's been my first short-term rental. As I was sharing with you earlier, Gabe, I'm a little bit hard-headed and I don't learn lessons very easily. So I learned some lessons. I didn't get a management company. I tried to do it myself at first and learn the hard way, as we all do. But it's been good. We've been able to, tons of profit. We've learned a lot in the process, but it's been good so far. And really, for me, I'm not so interested in the month-to-month cash flow. I'm more interested in I saved the 80,000 up front or 60,000 up front in taxes. And then I'm more interested in the appreciation over time. So I figure as long as I'm breaking even for this property in particular, I mean, I'd love for it to cash flow, but I was more interested in the tax savings and the appreciation on the specific property. And we've been able to break even. And so that's kind of the play there. And so a lot of high W2, if you're a high W2 earner, or a passive investor and you have a high income and you need deductions, short-term rentals are a way to be able to do that as long as you self-manage those. You could potentially take advantage of a huge deduction.
Yeah. Short-term rentals, it's definitely, it is a unique type of business and it has a learning curve for sure. So, but if you get these benefits, it sounds like there's definitely motivation and reason to do it.
Yeah. For some of us, definitely.
You also mentioned that you are investing in an efficiency apartment I forget what state it was, but it's in an opportunity zone. Tell us about that deal. Why were you excited about it? And then what are the benefits of investing in an opportunity zone?
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
Yeah, no. So I had some money sitting in a 401k from a prior career that I had before this. And, it was doing okay, wasn't doing great, and came across these opportunity zone micro apartments. A colleague of mine was looking at developing some land in an opportunity zone and putting in micro apartments, stabilizing them, and then selling them off. And so for those of you guys who aren't familiar with opportunity zones, there's a lot of tax benefits to investing in opportunity zones. So you can take your capital gains. If you have capital gains from either the sale of a property, the sale of a business, You take those capital gains, you invested in an opportunity zone. Opportunity zones were developed by the governor of each state, had to pick based off census data, different areas within their state where the income was at a certain level. And so the idea is to
I don't know a lot about opportunity zones. I've never used it as a strategy or
yeah.
invested in it. And how did they come about? Like, what is the government's perspective? What is an opportunity zone? What are they trying to do?
Sure. So I believe, if I'm not mistaken, I believe it was part of the Tax Cuts and Jobs Act. So part of Trump's tax overhaul back in 2017, they said, listen, we want to put money in low income areas. And we want to invest in low income areas and bring those areas up. Now, the interesting part is when they say low income, it's based off census data. So they took census data, and I believe it was census data from like 2010 was the most recent that they had. And so when you say low income areas, some of us think, oh, that's on the bad side of the railroad tracks. We don't want to go invest over there. The low income areas could be student housing. If you got a college town in your area, those college kids usually don't make a lot of money because they're going to school. But it doesn't necessarily mean it's a bad place to put an investment property. And so we've got some here, and I'm in Salt Lake. We've got some opportunity zones that are right off the main highway that goes through our state, right off the corridor. And so it doesn't always mean that they're in bad areas, but the idea was if you invest capital gains. So if I sell a property and I invest in that area, two things happen. One, I get to defer the taxes on that capital gain. So I don't have to pay taxes on that capital gain until 2026, the end of 2026. So if I would have invested in 2017 when this came about, that would have given me almost 5 years, 6 years to defer my taxes. So that was the first benefit, which is important, but you still have to pay taxes in 2026. The bigger benefit is those capital gains. If I keep them invested in that opportunity zone, when I cash those out, if I keep it invested for 10 years, let's say I take $1 million from a building I sold, and I take that capital gain, I invest it in a property, and I buy $1 million property, and 10 years later, that $1 million is worth $5 million. When I pull that money out, I pay no tax on that $5 million. So you have to keep it invested for 10 years. And it's not just a matter of going and buying a property in a opportunity zone. You actually have to improve it. So a lot of people are buying land and then building properties on that, and that's considered improving it. I could go buy an empty abandoned warehouse and then put money into it and fix it up. You can't just go buy a property and hold it. You got to go into an area, fix it up, develop it. But if you meet that criteria, that all that appreciation over those 10 years, you can pull it out tax-free. So the idea behind the investment I'm in is we're building micro apartments, stabilizing it, selling it off, taking all that capital gain and just doing that over and over. Every time I move that money, it's going to get larger and larger over time, and then I'll be able to pull all that out tax-free. So that's the idea. It's been good so far. This is my first project. We've got it, I think it's about half full now. They just went online a couple months ago. They're at about half capacity, getting it rented out. They'll stabilize it for about a year, then they'll sell it. We'll take those capital gains and go build a new property in an opportunity zone. Those capital gains will grow, do the same thing, and we'll just keep doing that for the next 10 years, and then we'll be able to pull that money out tax-free, hopefully. So
that's crazy. I did not know about the tax-free portion of opportunity zones. If you keep it in there for 10 years, you can take it out tax-free. That's great.
Yeah.
It's funny you mentioned that the census in 2010. This is a complete aside, has nothing to do with anything, but I graduated college in 2009 and no jobs at the time. There was nothing out there. And so one of the first job I actually, well, not the first, but one of the first jobs I did was I worked for the census, the 2010 census. I went around people who didn't fill out, I think it was like they didn't fill out their census paperwork correctly or something.
Sure.
I went and knocked on their door and I was like, hey, you need to fill this out. It was an interesting job, but anyways, I'm going to take that opportunity and move us on to the quick question round. Are you ready?
All right, I'm ready.
All right. Starts with education, could be any form, could be books, movies, whatever. I just need 2 recommendations, one for general life wisdom and then one for real estate.
Ooh, general life wisdom. Eckhart Tolle. I'm trying to remember the name of the book.
Oh man, what is that
not
one? Eckhart Tolle.
It's not the one that everyone's read. He had two books. It's the second book, but
Yeah,
that's
the Power of Now is the first one.
oh, maybe that was it then. It was the other one's the Secret. Did he write The Secret?
No, he did not. But
So
also
maybe
a
it
good
was,
one.
yeah, that was a good one, but I think it's The Power of Now. That's
Yeah.
the one I read. So that one really opened my eyes to a lot of things. So I would say that for personal. And then for business, I mean, I hate to relate it to tax because not everyone's into tax, but for me, there's a gentleman named Tom Wilwright who is Robert Kiyosaki's CPA, and he has a book called Tax Free Wealth. They've come out with a couple different editions. I think there's a new edition that came out recently, but that was a really eye-opening book for me on how the government, basically the government sets up the tax code. There's about 4 pages that tell you what you need to pay tax on. The other 8,000 pages tell you how not to pay tax. And so
8,000 pages.
you've got to understand that book. And so there's a lot of ways. And so he kind of walks through it in a very layman's terms. It's called Tax Free Wealth. Great book for anybody who wants to read it, who finds himself with a tax problem.
Perfect.
Yeah.
Good recommendation. All right. Next question is for your younger self. Let's go back to the Erik who was just getting started way back whenever that year was. Go back to him, look him in the eye, give him one piece of advice moving forward.
Stay in your lane and know what you're good at and hire out and build a team around you. So again, I had to learn the hard way, but I'm not good at everything. I'm not good at marketing. I'm not good at property management. I'm not good at screening these tenants. That's not my forte. And so hire and stay in your lane and be humble to know what you're not good at and hire people who are good at the stuff you're not.
Stay in your lane and hire what you're not good at. I feel like is just prime advice for a younger self because it's so easy to bounce around and do things that you don't necessarily have skill in. And so if you just focus on what you're good at and hire everything else out, you're doing something right. So good advice. Let's go on to the next question. This is about the US. It is a big place. There is a ton of opportunity out there. Give me the single metro you're most excited about investing in today.
That's a good question. So this is going to be local to my area because I don't tend to invest outside of my area. So I'll give you a local. But as many of you are aware, Salt Lake City held the Olympics not too long. Well, I guess it's been a while now. But there's a good chance that we're going to be holding the Olympics here in the near future.
Oh, wow.
And so Park City, Utah, where they have a lot of the Olympic events, has been going like crazy. And I think a lot of people are looking to invest in Park City in hopes that Utah gets the Olympics again, which I do think they will. So I would say Park City, Utah, right now.
That would be an interesting investing strategy is just predicting the Olympic cities and then investing in those cities.
Yeah. I don't know that I would suggest that, but we did have there was huge success in the first go around. And so, like I said, because we have the infrastructure, we've got all the ice rinks and the ski hills and lifts and all that stuff. There's a good chance the Olympics are going to come back here. We just don't know when. And so people are already starting to invest in those areas where they hold the Olympic events because it gets such notoriety to those areas that they saw a huge influx of tourism. And so Park City is one of those areas. It's expensive to invest up there now, but they're building like crazy up there. And so there still are some good investments up there.
All right, perfect. All right, that leads us to the last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a two-parter. Where can they find you? And then what can they expect when they reach out?
Yeah, so please reach out on either LinkedIn or our website. I think you mentioned our website. It's just www.costsegauthority.com. My contact information's out there. My phone number's out there. Please use this as a resource, you guys. We don't bill by the hour. We're kind of a niche accounting firm where we just do these cost segregation studies and a few energy credits. Don't call me and ask me about child tax credits or earned business income because I don't know anything about that stuff. Back to staying in my lane. I know a lot about depreciation and little about anything else tax. So if you have real estate questions, tax questions, please feel free to reach out to us. We always get back to you. We want to be a resource for you guys. And again, we don't bill by the hour or anything. We just want to be a resource and help you guys in that arena if we can. So
perfect. So that is costsegauthority.com. I will put that link in the show notes. So if y'all want to reach out, just click a little more in the description. It'll pull down that full description. In there, you can find the link. All right, Eric, that wraps it up. Thank you very much for hopping on the show.
Yeah, thanks for having me, Gabe.
Absolutely. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, need any advice, whatever, just reach out to me, Gabe at therealestateinvestingclub.com. If you want to support the show, just give us a like, subscribe, share, all that jazz. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.